But basically, the fair value gap forms because there's so many orders in this one candle that price gets pushed down way too much to where price can't rebalance. And the reason why price can't rebalance is because of these wicks, right? Wicks do the damage. They actually activate the orders, and they just can't get all the orders through. So why is this important? Well, it's because the algorithms can refer to these skip levels because these are unfilled buy and sell orders, and that basically causes inefficiencies. So I do have the consequent encroachment of the fair value gap labeled here.
Turn that off. My fault.
I have the consequent encroachment of the fair value gap marked, and ideally, in strong order flow, we do not want to see this encroachment. We do not want to see 50% of this fair value gap get traded into, because that shows intent to go lower, right? If price trades into the consequent encroachment, that does not mean the fair value gap is going to fail, but it definitely makes it less likely to hold and to be respected. So the next thing is liquidity. Liquidity is obviously very simple. It's between old swing highs and swing lows. And the reason why is because a swing high is basically just a reversal. As you can see, price moves higher, right? As price moves higher, we get the swing high, right? And then we move lower. So at this area right here, it is given that, buyers were in control, but then sellers overtook the buyers, right? So price moved up, and then price moved lower, and that means that sellers came into the marketplace at this area. And when they enter their positions, right, their stop losses are usually somewhere above the high, right? This is just classic, trader psychology. We want a stop loss decently close to where we entered, and this is the reason why there's a bunch of liquidity up here, is because, well, there's clearly a reversal showing up here, but then there's going to be a bunch of stop losses up here. So the next thing that we use is institutional order flow, or a change in state delivery. So this is basically where we have a trending market, such as in this example, right? We had a bearish trending market here, right? And then we had a change in state delivery, which is when the opposing candles, when down close candles get closed over to, right? Because in institutional order flow, opposing candles must be respected, as that's where smart money has put in their positions. So basically what this happens is, in institutional order flow, basically what happens is price should respect opposing candles. So in a downtrend, our opposing candles would be these up close candles, and in an uptrend, our opposing candles are down close candles. So a change in state delivery is basically when this trend is broken, right? So in this case, we have a price move lower, and then we come back around these down close candles, right? We should not be, closing above these down close candles in a big bearish trend, right? So this is a change in state delivery. And as you can see, as we move higher, you can see how these down close candles are being respected. We find support off of this, and we move a little bit higher before we get another change in state delivery, right? This is a bearish change in state delivery, right? As we run higher, and then we get a very big displacement lower, and we get our change in state delivery. As we move lower, you can see how up close candles are being used as resistance, right? As we come up, we come lower, we close below it, right? And then we move lower. And as you can see, consistently up close candles in a downtrend are being supported, and we move lower. So that's basically institutional order flow. And then the most important thing I love to use is protected swings. And these are the protected swing points. So this kind of puts, our institutional order flow, our change in state delivery, and our swing point into one, basically. So a protected swing is an area that we don't expect price to trade back into. So how do we identify this? Well, first of all, we have to know if the market is trending or not. So if we're in, a downtrend, we should see up close candles being respected. So any up close candle that forms a swing point, that should be protected if there is a change in state of delivery, and that's whenever opposing candles gets closed through. Now, ideally, this is very common sense. We use a key level, right? The best protected swings form from a key level, such as a swing point being taken, or a fair value gap, liquidity sweep, fair value gap, any type of key level. We have to have conviction of why we should move away from this given area. If we just have a protected swing and it's off of no key level, we're not rebalancing price, we're not sweeping liquidity, then there's really no reason why we should be moving higher or lower. So the next very important topic that I don't think gets talked enough about, everyone says that prime is fractal, right? Price is fractal, time is fractal, everything like that, right? So the reason why time is fractal is because no matter how you really look at it, price and time are always fractal. So I'll just quickly explain how this works. So the algorithm, or if you don't believe in an algorithm, the market basically moves on the logic of, it basically repeats the same logic on all time frames, right? The price delivers from the same elements, liquidity runs, displacement, order blocks for value gaps on all these time frames, right? Monthly, weekly, daily, 4 hour, 1 hour, 15, 5, 1, right? Price has the same signatures regardless of what happens. Like literally, like you'll see, I could show you a chart, I won't tell you the time frame, and you cannot guess if this was a monthly or, you know, a 4 hour time frame or a 5 minute time frame, right? Because there's no difference between, you know, a monthly and the 15-minute well. And the same model appears on every single time frame. You'll just see the same thing in reverse. So basically a 4 hour sell model. So let's say we have like a 4 hour, I don't know, like fair value gap, right? Inside of that 4 hour fair value gap, we will see a 1 hour sell model. And in that same 1 hour sell model, we're going to see a 1 minute sell model. So it's just bigger or smaller. So basically what this is that if I give you a chart and I don't tell you what time frame it is on, you could read the chart perfectly fine, but you're not going to know what time frame it is. So what is truly fractal time? So this is the key to what I think fractal truly means, right? So a fractal time, the higher time frame narrative repeats on the lower time frame. So for example, if on the daily chart, let's say you see a daily bearish bullish for value gap, right? If you drop to the 4 hour, you'll see the displacement that created it, right? And you also see, you know, other fair value gaps on the 4 hour. If you drop down to the 1 hour, you can find fair value gaps and order block inside the same move that you can trade off of. And then on the 5 minute, you can see actual entries that express the same narrative. So this is fractal, the same logic cascading downwards. So the algorithm doesn't change. It really doesn't. Price delivery is constant. Your time frame only changes how much of the delivery you'll see at once. So if you think about it, a daily expansion candle is realistically on the 5 minute a huge move, right? So if let's just say, you know, you're trading the 1 hour candle, right? You might only get a few pieces of the pie in that whole candle, right? So but then on the daily time frame, you're going to see the whole move. So basically the pattern is fractal because the same processes create all time frames. They're just magnifications of the same algorithms. So basically it is kind of complicated, but if you do want to, you know, the key principle is that time is fractal because the algorithmic delivery of price repeats identically at all time frames. Higher time frames set the narrative, lower time frames expect its details. So, you know, a daily bullish candle is literally on the lower time frames, just a bunch of fair value gaps, you know, price taps back into it, we move higher, stuff like that. So the last thing we're going to kind of go over is market maker models. This is the cycle of which the market moves. And it is very easily overcomplicated, in my opinion. And, you know, it's only a few very simple steps. So these are the parts of a market maker buy model. I spelled model twice. We have the original consolidation, engineered liquidity, distribution, and smart money reversal. So the original consolidation, it does not always have to be a clear consolidation like this. It could be we kind of move up a little bit, maybe kind of move up, a few short candles. But it can also even be a swing point. So this first accumulation range is where smart money builds the inventory before the stop run and displacement that begins the market maker model. So if you know anything about relative equal highs or lows, loss of liquidity above this because retail sees this as resistance. So that's why I see here, tight range, right? Very low volatility. equal highs and lows, right? Equal highs here. And no displacement yet. Of course, we're consolidating, no displacement. So the role of this is to establish the primary liquidity pool for the future due to swing. It creates a structure that defines the left side of the model, and it serves as the origin point for the entire market maker curve. So this is where the market maker model starts, right? The second thing is engineering liquidity, right? This is the inducement phase. Smart money creates clean highs, lows, trend lines, and tight consolidations. So as you can see here, there's quite a trend line. If you follow my mouse, retail will see this as a trend line. You have low resistance liquidity here, right? And every single time we move lower, retail thinks, oh wait, this is a downtrend, we should be buying here. So as retail moves lower here, they're putting their stop losses above these highs. So retail is induced to one side settlement, breakout, support and resistance, right? We have a breakout here, and then they're putting their stop somewhere around this area, and we just say it's this high. And this is just to build more liquidity up. We have the smart money reversal, and this always follows two distinct patterns. We have a liquidity raid, so we take out some sort of buy side or sell side, or we tap into a fair value gap, those key levels we were talking about. And then we have a change in state delivery. For us, the change in state delivery is here, but we can use this inverted fair value gap here as well. An inverse fair value gap is also a change in state delivery. It is not as high probability, but in these big displacement legs, sometimes you can get away with just the fair value gap. So in distribution, we see us returning to these key levels, right? And move higher to take out original liquidity. So as you can see, we move higher, we have a retracement lower into this fair value gap, giving us another change in the state delivery, right? Those down close candles get run above, and we target the original consolidation. So that's basically it. This week was kind of short. These are very basic ICT concepts that I feel like should not be more explained, but more practice. So that's why I have a little homework thing. If anyone wants to do it, you can go through this week's or last week's PA to find any examples of the market maker models and all the concepts discussed that we used. And feel free to post them in the ICT study channel, and I will review them for you. Next week we will get into more advanced concepts, power of three with market maker models and key opens. This is the bulk of my model, which we will discuss probably on Friday. But yeah, so that's basically the whole slides, and then we're going to kind of go through today and kind of see how this thing worked, and so you guys can actually understand kind of how this actually goes into the actual charts. So this is my chart of the NASDAQ for today. So we're going to kind of like go through what kind of market maker models there were, what kind of like stuff that we kind of saw. So we're just going to go over the very basics. So we're just going to go over fair value gaps, liquidity sweeps, or market maker models. So so coming into the day, I was bullish. I'll explain why I was bullish. As you can see, there is a market maker model, right? On the lower time frame, on the 1 hour time frame here. You can see how there's a market maker model, right? Clear market maker model. What is this? Our smart money reversal. As you can see, I would consider this could be original consolidation, right? As you can see, we're kind of moving around in a little bit of a range, creating, liquidity, right? And the original consolidation, you don't always have to be exactly right of where the original consolidation could be. If it expands past the original consolidation, then you could always just shift it up. But in this terms of this class, I would consider this to be the original consolidation. And as you can see, we're starting to generate liquidity lower. And we do get the tab of these relative equal highs. That ahead is a draw on liquidity. So as you can see here, if we're going to study our smart money reversal, we move lower, right? We purge liquidity, right? This is sell stop. This is just liquidity, right? And we have more liquidity on this side, right? We have all this liquidity here, right? All these swing lows. And then we have our change in state delivery, right? We're going from a bearish market to a bullish market. So these down close candles are going to start getting disrespected. And then later we can see these protected swings, right? And we're going to go over each protected swing. So initially, this is our protected swing, right? This is our initial protected swing. That's our smart money reversal. As we move higher, there's another protected swing here. Why is it a protected swing? Well, we have these down close candles that gets closed above, right? So this would be a protected swing, right? As we move higher, we have another protected swing here. And then as we move lower, as we come into Tuesday, we have another protected swing here. So you can see our institutional order flow is bullish, right? Down close candles are being respected, right? We're moving higher, we're trending higher. And then, so this supports a bullish narrative, right? Smart money reversal, bullish institutional order flow, and a market maker buy model. So coming into, that's why I was bullish coming into the day. So this kind of understands how price is fractal, right? We have a very big market maker buy model, so we're bullish. And then if we zoom in on the 15-minute, right, this is how price is fractal. Inside this bigger 1 hour market maker buy model, we have a smaller 15-minute market maker buy model. So this one's a little more messy, and this kind of just shows how price is not going to be perfect. So
Yo, Cash,
we could
can you
consider
mute, please?
Smell it.
So this is kind of messy,
Huh?
but
I need to see.
this can be considered our original consolidation, right? We don't have to be, our original consolidation does not need to be actually a consolidation. It can be a swing high. So London sits to high, we move lower, we come lower, right? We sweep out London lows right here. And we do get a change in state delivery, right? Right here, change in state delivery. And then afterwards, we come back down, right? So this is our smart money reversal. What should we come into next? Distribution. And we do, right? We have this 15-minute bullish fair value gap with 50% of the open range gap. And we move lower, right? We take out that. We take out, this London high that we consider as our original market maker buy model's original consolidation, right? But that's okay, right? Because we can always take entries, right? Because we do have the inversion for value gap right here, which can also be a change in state delivery, right? And we move up. We probably tap some inner 5-minute for value gap. Here we have a volume imbalance here at 8:30. This is a key opening time. We'll go over that next class. But key opening time, we have the change in the state delivery right here. And we move higher to take out the original consolidation. So as you can see, in the larger 1 hour market maker buy model, we have a smaller 5-minute, 15-minute market maker buy model here too. And after this was finished, I expected us to target, these relatively equal highs. And that's what I took here. I called this out in the Discord, if y'all can see. It's in the general chat, and I called this out. So basically what it was this is actually another smaller 1-minute market maker model inside of a bigger 1 hour market maker model. So you can kind of see how we have the original consolidation here. It can be, you can consider it this range, or you can just consider this swing high. Move lower. And then as we move lower, this is a 5-minute inversion for value gap, confirming the smart money reversal down here. And afterwards, you can see how we start to get, key levels forming and protected swings. So purging liquidity here, change in state, right? We move higher. As you can see, this is true institutional order flow right here. Down close candles are being respected, as you can see here. So after seeing down close candles being respected, the next set of down close candles should be respected as well. So the second we get them, we come up, close through them, we come back down, retest, right? We enter here, and we move higher, finishing our market maker buy model, right? So this is a smaller 1-minute market maker buy model. inside of a bigger, 15-minute and 1 hour market maker buy model. So this kind of shows you how it works every single day. We can even study Tuesday if we really wanted to. Tuesday, same logic, right? Smart money reversal. On Friday, we move higher. On Monday, and then Tuesday, we expect something else, right? Expect around the same thing. This is, I'm pretty sure, a 1 hour SIBI BIS here, right? This is a key level that I talked about, 1 hour for value gap. What do we expect off of this? A reaction higher. So as you can see here, that's our down close candles, right? Down close candles, institutional order flow, protect the swing. And, same thing happened on Monday, right? Monday, we have new week opening gap. We trade into new week opening gap. We come in here, down close candles. We move higher, right? This should support price. This low should be protected. Now, if this low is protected, we should be trading bullishly, right? We should not be coming back down and take down this low. So that gives me confidence to trade, eventually higher. And then, as you can see, this low should be protected. We move higher, and that gives me confidence to take longs, because if we're not coming down to take this low, how do we protect this low? We displace higher, and we eventually get our relatively equal highs here. So that's basically it. I'm going to open the floor to any I'm going to open up the channel to any questions, concerns. You can ask now. You can just unmute. Okay. We'll do we'll do your question first, and then I see you, Barn. I see you.
Maybe it's a stupid question, but what indicators do you use?
Oh, of course. Okay. Indicators, right? ICT, kill zones, and pivots.
Screenshot.
I can show you. I can send you them. Like I can.
Yeah, sure. That's even better.
Literally, I can literally just put them in here. ICT, kill zones, and pivots. This is just a watermark indicator. AGFX watermarks, and I just put my stuff up here. Multi-time frame candles, just so I can see what the larger time frame looks like. And then news by 2 degrees. This basically just lets me get 4x factory under trading view, so I don't have to go to 4x factory and look. And it tells me when the times are and everything.
Well, thank you.
I got you. So Barnes says, how can you explain exactly how when a predicted high or low, when a low or high is protected? Of course I can. So so when I talk about a high or low, I'm talking about a swing high and swing low, just so there's no confusion, because technically this candle's low is a low, right? So a protected low or high is formed when we come into a key level. Ideally come into a key level. Sometimes you don't, but most of the times, and for the sake of this class, you do want a key level. So this is what I would consider a protected low, right? So what creates a protected low? We purge into a key level. So we go back to this, right? Protected swings, institutional order flow. Remember, opposing candles should be respected in a trading market, a key level, and a change in state delivery. So this low should be protected for 2 reasons. Why? One, we purge into this key level right here, right? And we respect 50%. If I turn on 50%, you can see how we respect 50%, right? Come, and then after respecting 50%, we have a change in state delivery, right? So a protected high or low is when we purge into a key level in a very trending market, right? We're clearly in a trending market. And we purge into key level, and we have a change in state delivery. That's really it. Key level, change in state delivery. But the most important part is narrative, right? So the reason why I expect this to be protected is because I'm bullish, because there's a 1 hour market maker buy model going on, right? So if we're actually going to take out liquidity that was engineered previously, we should see lows being protected, right? So it's really about narrative. But if you want the textbook definition, it is a purge into a key level and a change in state delivery. So, Barn, does that answer your question? Yeah, I got you.
So sorry, just a follow-up question on that. So eventually it's going to have to, swing past that key level, the swing low. How do you know when it's not protected?
So when it's not protected is just really based off of what you're saying, right? Because if you think about it, right? So I'll give you an example. So by textbook definition, this low, this high right here, should be protected, right? We have the classic, textbook definition, right? Purge into a key level, right? We have a purge into the swing high, and then we have a change in state delivery. Why do I not think this is going to be protected? Well, it all comes down to narrative. Where is price going to move, and how is it going to move, right? So I know that price is in our market maker buy model, right? So we should be taking liquidity to the upside. So, and what is liquidity to the upside? This protected high, right? This supposed protected high. Protected highs and lows don't last forever. They only last for a certain amount of time. And how do you know how long they're going to last is depending on like what characteristics you think the market is going to move to. So for example, let's just say for some reason price reverses off of this, right? Let's say price reverses off of this relative equal highs. Let's just say we start moving lower, right? Let's just say we start moving lower. We just start moving lower like this, right? We get our change in state delivery. Now these protected lows, right? All these protected lows, I don't expect them to be protected anymore. Why? Because we shifted from a buy program, right, higher prices, to a lower prices, right? We think that price is going to want to move lower. And how does price move lower? To draws on liquidity, which are the swing lows. So I expect them to no longer be protected and to just move lower. So hopefully that makes sense.
Okay, cool. Thank you.
Yeah, I got you. So any other questions? I'll be here. Any other questions? If not, I just want to thank y'all for coming to this class. We're going to have another one probably around the same time on Friday. We're going to obviously talk about more on key opens, power of threes, and more advanced market maker models. That's basically the plan. So I'll just stay in here.
I have one last question.
Okay, yeah, for sure.
It's like more so about you. Like, how long have you been trading for? And like,
I've been trading. I can pull up my trading view. I joined in 2022, so it's probably like 3 years, I guess. About 3 years, I guess. More than 3 years.
awesome. Thank you.
Yeah, I got you.
Do you have any like a YouTube channel to review?
I do.
I
I kind of stopped posting on it just because of school and stuff like that. I'm a senior in high school, so I definitely do want to start posting more.
Wait. Pause really quick. Did you just say you're a senior in high school?
Yeah, I'm 17. Yeah.
Holy sh!
Yeah. I started early. I started around so 2022. That's like end of COVID, basically. Kind of got into.
So like you started trading when you were like what, a freshman, sophomore?
Yeah, basically. Yeah. I think it was like a freshman year.
And how's trading working out for you?
It's been pretty good, honestly. Like, I don't really pay attention in class. I'm in the back on my laptop, and that's why I usually trade during school. But I definitely don't trade as well in school. But I still try to trade it. That's good if you miss this day and you don't feel like you're missing much. It's pretty good. But yeah, if anyone needs help on anything, or always you just at me, and I'll take some time out of my day to help y'all. I do this for free.
All right. Well, I appreciate you, Jared. I'll be seeing you on Friday.
Yeah. All right. Peace. So if no one else has any questions, I'm gonna log off too. Got basketball practice in like an hour, so
Well, thank you for everything, bro. Keep it up.
I got you.
That's sick,
Thank you.
especially for your age, bro.
Yeah, thank you.
Alright, take care.
Hey, peace. Hey, y'all have a good day.